Good morning, welcome to Join the Dots, Friday morning. Now yesterday I said we were going to do a 2-day presentation, and this is the second day obviously. I want to refresh your memory though on yesterday, because these 2 days are so important to your wealth. Right, yesterday we talked about the relationship between gold and stocks, and we have to look at the results so far this year. The S&P's up 9%. My Agnico's up 65%, my Pan American's up 40% plus. There's no comparison, but we haven't hit the crisis yet. Now this is very important, okay? There is, as Goldman Sachs quite rightly point out, an inverse relationship between gold and stocks in a crisis. And we know that from 08, and we know it from 11, and we know it from 20. Every single time the market falls, gold rises. But what have we seen in the last year? We've seen gold rise and the market rise. This is not normal. So yesterday, I gave you that Andy Schechter piece. I said there are going to be thousands of predatory cockroaches out there trying to sell you gold and silver in the next 6 months. Please take the time and research it. Remember, carry your phone, check the spot price against whatever they're selling you. All right? The difference this time is that a massive amount of silver and gold has been taken from the float, which is what the exchanges hold. Like a market maker, they hold the stocks ready to buy and sell. They have to have the liquidity in the market. It's gone. There are no stocks being held. There's no float, as they call it, on the exchanges. This is critical, okay? So I've told you what we've got at the moment. In my view, if you had to do a cartoon of where the public are in the stock market, they're over the cliff, legs spinning, waiting for gravity, just waiting for it to pull them to earth, and all their value, all their wealth gone. That's what's coming. And the insiders know it. As I said to you yesterday, Bezos has raised $6 billion cash, $6,000 million. Where's he put it? I should bet a fair bit's gone into gold and silver. Okay, so what we also know is the public have only got half a percent of their assets in gold and silver. And we know that from Morgan's, who said the same, 0.5% in gold and silver. The average or the mean holding in gold and silver is 2%. So they could uplift by 300%. They could increase their holdings 3 times and only be at the mean. But we're coming to a crisis. So they'll go way past the mean, won't they? Way past the mean. That's what happens in a crisis. Inversely proportional, as Goldman Sachs says. So I'm giving you all the big names, Morgan, Goldman's, okay? So in my view, the public will be led to the slaughter. Now, what I'm going to do now is look at, yesterday I ran you through a piece and I read my notes out, which I send to clients. And I'm going to do the same today, because there's one excellent piece out, and the final paragraph of the first section is the key. There is a direct inverse relationship between stocks and gold and silver in a crisis. Okay, you know we're in a crisis. If you don't, you're sleepwalking. You haven't a clue what's happening. You know the employment's crashing. You know people aren't even going to McDonald's for their breakfasts. You know that jobs are going. You know that the employment statistics have all been a lie. You know that now. It all came out in that BLS report. BLS must stand for bullshit, I think. Anyway, there is this inverse relationship, and it is critical. So what we've seen so far, okay, what we've seen so far is stocks have risen, the S&P up to 6,500 almost, but gold's risen to 3,003, 3,004. Something is wrong fundamentally for both of those to rise at the same time. When this one falls, stocks, this one will accelerate. Because that's what happens. It's inversely proportional. It accelerates as stocks collapse, because people are getting out of stocks. Remember Exeter's pyramid. Remember, they're getting out of the things they can get out of, and they're buying things that represent safety. So they're out of stocks into gold and silver. It's simple. Yes, this time we have crypto to complicate matters, but that's why I have gold, silver and crypto, because those are the things that the public will recognise as much safer than a collapsing stock market. with insiders selling billions. Warren Buffett cleaning out his portfolio as much as he could. Bezos selling $6 billion worth of Amazon. Please take these indicators as they are. Indicators telling you what's coming. So let's think about the stock market as it is. Okay, I've told you, the people are over the cliff. It's that famous cartoon depiction, isn't it? They're over the cliff, their legs are spinning, and they're just waiting for gravity to pull them to earth and take all their savings with them. It's very sad. It doesn't need to happen. The multiples in the market at the moment are 29.85 on the S&P. What is the mean? The mean is 16. So it could halve and be at the mean. Can you see that? It can halve, so it will. And there is record leverage, and there's record margin. And the insiders are executing record sales. The economy is falling rapidly. PMIs, consumption, jobs. We are at the high point of the economic cycle, just like they were in 1929. At the high point, just when the US started to bring in tariffs. See the links? They're all there. See the dots? Join them up. Join them up. They're all there. So the normal trade out of stocks and into gold and silver as recession appears obvious will see record demand for gold and silver. But there's no float. This is the exceptional moment for you. This is the one in a lifetime opportunity for you. There's no float in the exchanges. So if the public make a mad dash, normally a lot of them will move into ETFs, which is they will perceive to be the safest way. But those ETFs need to buy the gold and silver, don't they? To back up the ETF investments. How can they get the gold and silver? There's no float. None. That Andy Schechter video I sent you yesterday explained how all the gold and silver's been taken out the market. Taken out the market. There's no float. So what happens when people want to buy it? The price goes up. It's not difficult this time. 9 years out of 10, it's extremely difficult to see what's happening in the markets. This time it is so screamingly obvious. Okay, central banks have hoovered up all that gold and silver. They ain't going to sell. They're not in it to trade. So there's no float. I'll say that again and again and again. There's no float. But there's going to be a massive demand. So once the price reacts, as I say, there's going to be desperation. People are going to be desperate to repair stock losses as the S&P plummets back to the mean of 16 times future earnings. Only the mean. I'm not taking it below that. I think it will go to 10 times because next year that will be 16 times because the economy is going to contract, companies' earnings will contract. They're already suffering from the tariffs. They're already absorbing all those tariffs. There's no price increase coming through from the tariffs. I said that day one. I said there cannot be a price increase of 15-20% because the consumer simply won't pay it. So the exporters pay it. And their economy starts to fail, doesn't it? Because they're losing 15 or 20%. They're paying it straight to the US government and they're not able to pass it on to the importer or the distributor or the retailer. And if they do pass it on, that person is having to absorb it, so their earnings are going down. It is simple. It is that simple now. Okay, we are at the point where it becomes obvious. So I can see hedge funds, family offices, I can see the good traders, the clever people, the bright people buying gold and silver now. Once it starts to move. They can sit back at the moment, but once it starts to move seriously, they are going to weigh in and you should be with them because it's going to go up and the market's going to fall. So what do I see as a result of all this? All this obvious to me, absolutely screamingly obvious. What do I see the levels at when this settles? I see the S&P at 2,000 to 2,500. Now I called it right at 2,000 to 200 in 2020. When it happened, I called it right on LinkedIn. I said 2,000 to 200, 2,200. It bottomed at 2,198. Pretty good. This time I see 2,000 to 2,500. So 60-70% losses. Gold I see at 5,000 plus. And silver I see it certainly 100 plus and maybe a lot further, a lot higher. Because again, think about it. When the public come in to buy, do they buy gold at 5,000 an ounce, or would they prefer silver at 100 an ounce? They can buy a lot more silver. So they buy the silver. That's what normally happens. The public come in and buy silver. The institutions are buying gold. The hedge funds, the family offices, the big boys, the clever boys are buying gold. But the public will come in and buy silver, particularly. This is so logical, and yet it's a once-in-a-lifetime event. And I'm asking you, please, 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 think it through. Where does crypto go? That's the final question. At this stage, I can see XRP at well over $100. I can see other cryptos higher as well. Bitcoin I do not want to be in. I see a much higher risk than reward at 120,000. XRP at $3.50. I can see extremely good chance of huge profits because it has a function. Remember, Bitcoin just operates as a store of value. In other words, there's only 11 million coins. That's it. So basically, if people demand more, the price goes up. It's so simple. But there will be better opportunities for them in silver, gold, and other cryptos. There will be better opportunities than Bitcoin. Doesn't mean Bitcoin won't go up. It just means there will be better opportunities, better risk rewards out there in the market. So please, really think this through. I'll send you the link today to the article that I've taken the final paragraph of the first section to really hammer this home. You need to understand the inverse relationship between stocks and gold and silver. Stocks fall, gold and silver go up. Look at 2000, look at 2008, look at 2011, look at 2020. Every time, stocks down, gold up. It's automatic. So take advantage of it because stocks are not going to stay here. They are not going to stay here. They might actually go a little bit higher before they crash, but they're going to crash. The earnings are crashing. The whole rationale behind a share price is crashing. Okay, thank you very much.